Larry Shover is with us, the Chief Investment Officer at SFG Alternatives. Bring up the TNX chart because, Larry, you must be feeling good, my man, all right? Because throughout the selling of bonds in 2018, there you go, breathe a sigh of relief because the rally happened. What then are we to make of this? Does it continue, Larry? Did you think that it was going to go further? Is there more to go? Let us absorb your viewpoint.
Yeah, well, right now, curve compression is unbelievable. I mean, the 210 curve closed today within 1 basis point of the cycle's flat, and that's with a 10-year auction coming tomorrow. 30-year at 310. It's evident that the outright yields are in a consolidation pattern, given the enormous rally that we saw. However, curve compression is here, and I think a lot of it is that people realize we're in this low-inflation environment that's going to persist for a very, very long time. Yeah.
So, Larry, are the reasons for why you were bullish bonds when we talked, in the summer when we were selling off, are they the reasons that you see manifesting, or did something new come in here that pushed them down?
Yeah, no, good question. I think it's a little bit of both. I mean, first of all, when you look at the probabilities of caps, using caps and floors, the odds of the CPI averaging above 3% has gone in half, from 20% to 10%. On the other hand, the probability of CPI going below 1% hasn't changed at all since 2015. So I think it's just one of those things where we're capped in a low-inflation environment. What has changed is the oil price, which to me is more of a stimulus to the consumer. However, there's no inflation compensation for it, obviously, and that's going to, give us a repeat of 2015 and 16. So I do think, we're consolidating as I speak, but the long end of the curve will continue to grind higher in the environment we're in.
So it's basically just a timing situation then, essentially. Larry, it sounds like the yield curve expansion is something you still think that could take place. What do we need for that to happen?
Yeah, well, I think we need to see inflation. We need to see, real GDP go above like 3%. I mean, I'm projecting 2 to 2.5 for real GDP next year. With that said, I mean, I've no problem in thinking that 10-year yields will remain between 2.5% and 3.25% between now and 2020. I mean, obviously, it's hard to predict what's going to happen tomorrow, let alone a year or 2 years from now. But just given the structural issues that we're facing and, just the lack of inflation, which is quite evident, I just can't see a case for bonds going up above 3.25% to 3.5% for a long period of time.
Yeah. Okay, Larry, then the implications of this, if the bond market is playing out the way you've been discussing it with us right now, what else then? What's the next sort of knock-on implication of this? Does it mean that our U.S. dollar will have to come in? Does it mean that the market will continue to experience volatility? What's the next level kind of, iteration of this?
Yeah, absolutely. So, obviously, German yields would have to move for us to move in tandem. There'd have to be a major inflection point for dollar domination to be over. And, I was dead wrong on that. I just thought U.S. exceptionalism has run its course, but the market has definitely overshot and continue to do so. So, yeah, that's something that could definitely affect the yields. I just don't see it happening in the near term. The good news is that this isn't a bad thing for the equity market. I mean, it's I think we're far away from a recession. It's still a really good time to be in the equity market. We don't see recessions when Fed funds are, at zero, at least on an inflation basis. Profits are rising, margins are still going up, and oil is a stimulus to the consumer, not a headwind. So it's not all bad. It's just I think it's lower for longer when it comes to yields.
Yeah. All right, Larry. The last thing here before we let you go, I'm loving this conversation. Is there then a knock-on effect? Because what I'm curious about is we're talking about the 10-year yield, but if you look at corporate bonds as well, basically, there's a clear shift in terms of credit concern. And the reason I bring this up is because there's a debate basically about the health of the economy, and then there's also a debate about sort of the mechanics of the treasury market in an environment where you have deficit, funding that needs to happen. You have a balance sheet that's going to come off, stuff that doesn't necessarily, it could correlate, but it doesn't necessarily have to imply credit risk that we see showing up. It doesn't have to imply severe economic risk. So how are we able to separate out these two forces? Does that make sense?
It makes absolute sense. And I think the last thing to add to that is ECB with this last monthly bond purchase coming up. So a lot of people will be hiding under their desks with all the things that you brought up, and they're all really, really important points and things I think about every night. The fact of the matter is credit spreads definitely have widened, but not nearly as wide as they could be, or I guess as wide as they are when recession risk is there. When you look at the metrics, yeah, it is true that high yield credit has widened. Credit spreads have widened. That's a red flag, but still far away from what I would call recessionary risk. So that would be a knock on, something to look at. But right now, Costa's clear investing does not work. And I think the value continues to be in the equity market, also being long end of the curve, I would add that. And I'm looking for a 10 to 15% gain in the S&P 500 next year.
Yeah. All right, Larry, great stuff, Mr. Shover. We'll continue to look at it, and I know you will bring us the info. Larry Shover, Chief Investment Officer.
Thank you.
You got it at SFG Alternatives.